Welcome to this month's Gold Market Monthly Update brought to you by Phillip Futures webinar. I am Joyce Liu, Investment Analyst with Phillip Futures. In today's webinar, I will first take you through, very briefly, what we discussed in last month's Gold Monthly Update webinar. Then we will review what happened in the gold market since our last webinar. And lastly, we will wrap up with Gold Market Outlook. Once again, disclaimer, the presentation is solely for education purposes only. It contains my opinion, but does not constitute investment advice. If you wish to find out more about the risks and returns of investing in gold futures, please approach any representative from Phillip Futures for further discussion. So, let us begin. Recall our April webinar. We discussed in depth why gold prices dived 15% in 2 days. To summarize, there are 3 reasons. First, US economic recovery sets the stage for bearishness in gold market as investors see less need for safe haven assets and put out funds from gold into other cash flow yielding assets, such as equities. The beginning of a downward trend channel in gold prices starting in October last year coincides with the first hint of the beginning of the journey to recovery in the US, and as a slate of positive economic data later confirms this suspicion, funds parked in paper gold assets start to flow out. So there we have US economic recovery setting the stage for bearishness in gold. Second, surprise plans to sell gold from the central banks to cover their bailout fund gap pulled the trigger. In and on itself, the €400 million worth of gold sales is not sufficient to trigger such a sell down. But fears that other debt-ridden Eurozone countries will follow suit caused institutions to position out of gold. We explained why this fear is not irrational because selling gold from central banks' reserves is the least politically suicidal move. And the PIGS nation, Portugal, Italy, Greece and Spain, each has gold reserves between 8 to 176 times that of Cyprus' gold reserves. So more specifically, it is the fear of Eurozone central banks dumping their gold in exchange for fiat currencies that pulled the trigger to the plunge. Third, automatic cut losses gave the last punch. When prices breached certain critical levels such as 1530, 1480 and 1400, heavy technical selling and automatic cut losses were triggered by program trading machines, brokers, banks and trading houses. Some are forced to go into long liquidation to cut losses. So here are the 3 reasons why gold prices plunged. First, US economic recovery. Second, Cyprus gold sales. And third, automatic cut losses. What happened in the 4 weeks since then? An upward correction followed. After touching a 2-year low of 1321 on 16th April, prices started to rebound. But this rebound, as I would call it, is merely a correction of the impulsive plunge prior to that as markets recovered from the initial shock and took a breather. Why I would call this only a correction, not a trend reversal to bull, is because prices are hesitant to move higher. While the $240 plunge took only 1.5 days, the $165 journey of recovery from 16th to 26th April took more than 8 days to travel. The momentum of the upward correction waned off quickly, and gold prices traded sideways and range-bound between 1440 and 1487 for more than 9 days after that. Notice the green solid and dotted lines on the chart now. These are the Fibonacci retracement levels from the high of 1590 to the low of 1321 per troy ounce. The retracement, that is, correction, of gold prices follows very closely the Fibonacci retracement levels that I have plotted, with congestions at each of the levels as well as 1400, a key psychological level for investors. Now let's focus on the more recent prices of gold. Bearishness seem to continue haunting gold prices, and we are starting to give back some of the correction already. So exactly what is happening in the market to cause such uncertainty and hesitation? because there are much uncertainty in fundamentals and division in sentiments in the gold market. Again, three factors, and if you have been following our reports closely, you should be familiar with the 3 points below and have profited from them. First, the grand division in investment demand for gold. The upward correction that we mentioned just now was mostly a result of very strong physical gold buying. Physical gold buying comes in the form of jewelry demand and gold bars and coins demand. Since gold prices dropped almost $600 per troy ounce from its peak in September 2011, many retail investors, in particular Asian retail investors, snapped up gold jewelry, bars and coins. Physical premiums in India, China, Hong Kong, Japan and Singapore soared. But on the other hand, we have funds selling down on gold. ETF holdings of gold were declining at a rate of 0.5% a day continuously. Buying gold ETFs is another way of investing in and holding gold, and hedge funds and financial institutions who want exposure to gold usually hold gold ETFs. So here we have a disconnect between physical and fund sentiments. The key question here is the strong physical gold buying sustainable? Or to rephrase the question more specifically, is the strong physical buying as a result of a fundamental shift in preference from gold buying to physical buying as an investment tool, or a mismatch in market expectations between the large commercial funds and small retail investors? The former suggests a long-lasting correction and possibly a reversal, but the latter points to fleetingness of the correction and possibly a quick turn to the bears again. We have expressed our opinion that the mismatch in market expectations is more likely the case. Second, the grand division in the ground sentiments pertaining to economic recovery in the US. Now recall earlier on we mentioned it is precisely increasing signs of economic recovery in the US that set the stage for a downturn in gold market. But economists, analysts and politicians even are still debating whether US economy is indeed on track for recovery. Conflicting economic data did not help in this case. As a result, there is much volatility and hesitation in gold prices. The third factor of uncertainty, the grand division among central banks. Central banks around the world together lost about $560 billion worth of their reserves this year just because of the lower gold prices. At the lower prices presently, some central banks, such as that in Sri Lanka and South Korea, think it is a good opportunity to buy because the long-term strategy of central bank reserve policies should align with the long-term prospects of gold prices and not be affected by short-term movements, such as the recent plunge. On the other hand, some central banks, such as the Reserve Bank of Australia, questions the real intrinsic value of gold and, given its apparent lack of intrinsic value and volatility, doubts of the suitability of gold as a currency reserve also started to surface. Therefore, the question now regarding central bank gold positions is, will they continue to be net buyers of gold as they have been since the financial crisis of 2008 and 9, or will they reverse back to become net sellers of gold again? A reversal back to net sellers is likely to induce strong bearishness on the market. Now let us make some forward-looking statements. Regarding physical buying and fund flows, physical buying is abating among major Asian buyers, Japan, Hong Kong and Singapore, and even in India. Premiums have come off from their previous week highs and the queue in gold shops are shortening. In particular in India, there is a significant drop in sales since late last week, and sales are likely to remain depressed, at least in the short term, for three reasons. First, the second most gold-sucking festival, the Akshaya Tritiya festival, is over. Second, strength of the dollar against the rupee works against the favor of Indian buyers. And third, new gold import curbs in the form of consignment ban is likely to seriously dent interest among Indian gold importers. Traditionally, Indian gold importers contract gold from overseas supplier on a consignment basis and need only to pay the cost of the gold to the supplier after the sales have been made. By restricting consignments, the costs of importing gold for the Indian importer will surge and may force some less well-funded importers out of the market. Simplistically, this may reduce the supply, increase the price, and decrease the quantity demanded of gold in India. That is not to say all is gone for gold. We have one last bright spot left in the physical market: China. Physical buying in China remains strong, and there are anecdotes that many jewelry shops across the country have sold out on gold. But having all hopes pinned on China's physical market, that is also to say, if even China's physical gold buying starts to slow, another decline in gold market may become inevitable. So China's gold market will be our key watch point. On the question of whether the US economic recovery is on track, or whether it will falter, the accuracy of the answer to this question is not as important as the sentiment surrounding the two camps. So far, the market scale seems to tip towards the story of President Obama has been trying to pitch, the story of optimism in the US economy. Last Thursday, to a crowd in Texas, President Obama said that there are terrific things going on in communities all over America. And that the truth is there are a lot of reasons to be optimistic about where we are heading as a country after the tough times we have been through after the last several years. In support of the optimism in the economy, unemployment has been declining and stock market returns, viewed by many as a reliable leading economic indicator, is soaring. However, the optimistic sentiments are very vulnerable and may change any time. So we should be keeping watch, a very close watch in fact, on economic indicators, especially those pertaining to growth, such as GDP and various purchasing manager indexes, labor market, such as unemployment rate, non-farm payrolls, initial jobless claims, and to a lesser extent for now, inflation and interest rates. Better growth and growth prospects and better labor market statistics are likely to pressure gold, while increasing inflation and interest rates will support gold prices. However, we foresee a jump in inflation and interest rates to be unlikely in the near term. Now, the talk of high inflation has been floating around for about 3 years. But for 3 years, this high inflation did not materialize despite the Federal Reserve pumping record $2.5 trillion into the economy. Today, inflation is still trailing Federal Reserve's target rate of 2%. The Personal Consumption Expenditures Price Index fell to a 3.5-year low of 1% most recently. Why is that so? Let's look at the chart. The chart shows changes in monetary base, represented by the dotted lines, and bank lending, represented by the solid lines. Based at 100 in August 2008, monetary base had more than tripled in the US, represented by the navy blue dotted line, but bank lending in the US, represented by the navy blue solid line, did not expand correspondingly. Instead, banks have cut down on lending credit to the private sector. So the $2.5 billion that is meant to be circulating in the US economy to stimulate growth and spending have mostly stayed on the balance sheets of banks. Banks are reluctant to lend because they want to avoid another Lehman-like default, as well as to meet stiffer regulatory requirements on liquidity and capital. To kickstart inflation, banks will need to get out of this confidence depression, and this will not be an overnight process. Fundamentally, we are more on the bearish side. The technicals are consistent with our fundamental outlook. On the hourly chart of gold, prices have been tracking our Fibonacci retracement levels very closely, with congestions as strong support at 1424, the 38.2% retracement level, and strong resistance at 1487, the 61.8% retracement level, all within our expectations. Resistance was also present at 1400, which is a critical psychological level that we have repeatedly emphasized immediately after the plunge when gold prices first started correcting upwards. Starting from the big picture perspective, the 2-day plunge on the far left-hand side of the chart forms the main trend because it is impulsive. We view the subsequent upward and sideways movements as merely a corrective counter-trend to the main downtrend. Hence, we use the Fibonacci retracement indicator with 0% at 1321 and 100% at 1590. A closer look at the price patterns show much hesitation and bearishness. First, prices were repeatedly stuck at retracement levels and the 1400 psychological level on its way up. Second, the subsequent sideways consolidation has broken on the downside and is now trading in a clear downtrend. Third, MACD shows bearish momentum with both the MACD line and signal line below zero. Having now broken below 1400, we expect it to test the 1384 Fibonacci retracement level for the first time, today or tomorrow. If 1384 is cleared, we are likely to be headed south for 1321 again, but we foresee much opposition from bargain buyers and bullish investors on the journey down from 1384 to 1321. That said, as the 14-period relative strength index is trading close to oversold levels, there may be some sideways trading or even some short covering today. But in the mid-term, in the next few days to weeks, we are still looking for gold prices to be more on the bearish side, heading for 1321 after it has breached 1384. Thank you for staying tuned. We have now come to the end of our gold market monthly update for May 2013. I'm Joyce Liu, investment analyst with Phillip Futures. Please stay tuned for more market updates.